All right, let's talk Okta. As a big rally in the aftermarket here has hopes of a comeback, and one of the once favorite names of the cloud security batch, George Tillis with us from Salt Lake. Still losing money, George. $111 million, 111 negative on the GAAP bottom line, but it is an earnings decline that is less than expected. So how do we parse through this?
Well, I mean, on an adjusted basis, they're profitable. On a GAAP basis, they're still not.
Sure.
And I think that's, again, sort of been indicative of how it's performed in the past year, down about 19 or so percent. But, the report itself was actually really good when it comes down to earnings per share guidance, I suggest, for the next quarter as well as the year. But let's look at the actuals for the quarter also came in quite a bit above estimates at 31 cents versus the 22 cent estimate. So that was a significant beat on a percentage basis, and that is compared to a loss of 10 cents on an adjusted basis for the same quarter last year. So that's about 400 or so percent flip for adjusted earnings. Now, sales were higher by 23%, which is a respective increase, coming at 556 versus the 534. Now, I think the movement wasn't just the beat on bottom line EPS. I think that is part of it. The other thing is, if you look at the guidance for next quarter, they're guiding additional, if you will, increase of about 10 cents. The estimates prior for next quarter is 20 cents, worse 20 cents. Now it's somewhere between 29 and 30, so I'm just going to call it 30 on the high end. So that's another 50% increase on EPS, added to, of course, the beat by about 50% for the previous quarter, the one they just reported. And the other thing is, if you look at the increase in sales, it's a marginal increase in terms of guidance. The new estimate for the quarter or next quarter is 559 versus 552. But if you also look at the full year EPS, the prior to the report, I looked at it, it was around 91 cents at the midpoint. Now it's $1.18 with sales incrementally higher. So they're getting essentially an additional earnings per share boost for various reasons. Either they underestimated the amount of IT spending, or they reduced expenses enough to squeeze out some additional earnings per share. But at the end of the day, the total now for the fiscal year is $1.18 versus the 91 cents. Now, going into this report, you have to consider some valuations. Now, there's a lot of demand, obviously, for single sign-on solutions, cloud-based cybersecurity elements to, of course, remote access interfaces for workplace enterprise applications, but also, if you will, the hybrid work environment is in high demand for their services. But valuation was still very rich. And CrowdStrike also, by the way, is another one that, from a valuation standpoint, was rather rich. A little bit of a different story in that case, which I won't go into. But when it comes to Okta, I think this was a situation where there was underwhelming estimates for adjusted earnings, and they beat, but also guided quite a bit to the upside when it comes down to the remote workforce vendor sign-ons, of course, that Okta supplies the marketplace. When it comes to valuation, let me just say this real fast, that going into this, it was around 78 times forward earnings, which is rich. Now, if you take today's move by about $9 or so, give or take, that was just a moment ago, with the new adjusted $1.18, we're still around 68 times forward earnings. So I'm not surprised to see a little bit of a give back after the realization that the valuation is still very rich compared to historical averages.
Okay. So, George, compared to its past, cheap is a relative term, but $300 down at 73. Are we getting to the point where, the market's going to have to decide sort of what the end game for this company is? Because it sounds like they are starting to, turn on the profitability spigot to some degree. Maybe that's not the right word. It's more like slow down the bleeding kind of on the bottom line. So I feel that integration with the bigger cloud services company might make sense. I've always kind of thought that for Okta, but then people love their technology and say that they still have a lot of disruptive power. So what type of valuation should this trade at?
Well, I think we think alike in many regards, OJ. I thought about this as well. If you look at what's happened from an industry group standpoint, Ping Identity was a competitor. They got bought out. They got taken private. Citrix also was taken private. If you look at Duo Identity, that's another sign-on cybersecurity company. They were purchased by Cisco. So, I think you're onto something. I think there's the end game for Okta is integration amongst a larger company, but the question is who and when? I don't know. NetApp is potentially a bidder of this company. I'm not speculating here. I just look at how the industry group is consolidating.
Right.
So that, I think, is the end game for Okta. But at the end of the day, the earnings profile is improving quite significantly. I'm not surprised to see the movement in price that we're seeing in the after hours based upon the revised guidance for next quarter as well as the full year. And it's coming off of a very low base. And the guidance prior to the updated guidance they provided was all for 4 quarters of full adjusted profitability versus in the last 4 quarters where they only had about 1 quarter of profitability.
Okay. Sounds like this is a meaningful report for them, adding on to some of the progress they've made this year, but still a little bit further away to some extent from where other cloud companies have been able to kind of flip the switch and get there faster for compelling bottom line profits. Excellent work on the earnings this week, George. Thanks a lot, and I will see you on Monday.